not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices. So far it's in line with my base case, which was that they probably would have ring-fenced their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that, and that's what the executive order said to do. Basically, take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the Treasury's authorized to explore budget neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and reserves, forfeitures and seizures, they put them into a different bucket, and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good, because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, is kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years. I try to give conservative targets. And for example, I was pretty sure we would hit 100K, and we did. I thought maybe we would hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying, it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about,
Sure.
want to be able to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like to put it in real estate terms, if there's like say 20 houses on a street, and none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price. Generally speaking, the value of that the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio, because basically the cost basis, the average cost basis, is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices. This is kind of the outcome of having the dollar be monetized, to be treated as like global money, whereas other monies don't really have that same usage. So most currencies trade when they have like various fluctuations against each other, they mostly trade on things like what's their trade balance doing. So they generally, if they run trade deficits for a while, often it will correct against them, usually not pleasantly, but that'll kind of fix that structural imbalance, as well as interest rate differentials. And that's kind of how the majority of currencies function. And what's interesting about the dollar is that because the dollar is held by most countries around the world, often in the form of U.S. treasuries, but also like literally deposits in U.S. banks, deposits with the Fed, as well as U.S. capital markets, it basically means that in addition to those normal things, the dollar also has an extra monetary premium on top of it. And so it kind of makes the dollar overvalued on a trade balance basis. And it's also used as the global financing currency. So it'll often be the case that, say, a firm in France helps finance an entity in Brazil, it'll be with dollars instead of either of their currencies, just because it's the leading network effect. It's the ledger that multiple different entities can use. And the offset of that is that basically everybody in the world needs dollars because they have dollar liabilities. They invoice things in dollars. And the way that they get dollars is they basically overvalue the dollar. And therefore, American import power gets very strong. We send dollars out into the world, and our export power is weak, especially for lower margin things like manufacturing. We're still good at tech and healthcare and finance, but not so much manufacturing compared to many other peers. And this over time, it sounds like a good thing at first. We're sending dollars and we're getting goods in return. But the other way to point out, and he has that full kind of capital cycle, is that when we send the dollars out there, foreign entities come back and reinvest it into our capital market. So what we're actually sending out is ownership in our companies and our property compared to the rest of the world. And we're basically buying depreciating goods by sending them parts of our appreciating assets. And it also has an imbalancing effect, because if you work in the Rust Belt, the reason it became the Rust Belt is because we deindustrialized. Whereas if you work in capital markets, or if you just happen to have a lot of assets, you've generally benefited from this arrangement. You can travel the world because the dollar is so strong. Your assets, the whole world's investing in the same assets you are. So they're generally up and to the right. And over decades, you start to get rising populism, rising discontent with that approach. And so I do think it makes sense that they are trying to basically reverse course out of it. And the only part that I might push back on in those charts is that the administration has a little bit of a two-sided aspect here, which is they have all these kind of detailed views of what they want to do for trade realignment, but they say that they want to keep the dollar as a global reserve currency. So, for example, if they saw that chart that says, okay, instead of the foreign sector investing in treasuries, they're going to invest in gold or Bitcoin or whatever. There are elements in the administration that would say that that's not necessarily our goal. Whereas there to be other elements in the administration that say that is our goal. And I think that's that's probably one of the challenges they have to navigate.
Because the challenge there being we don't want to lose. We need the dollar to weaken, but we don't want the dollar system to kind of fall apart either.
Yeah, essentially, there's a trade-off by being the global reserve currency issuer. Is basically you get a huge sanction power, and the government it has much easier time finding itself. So, for example, Brazil has similar deficits on a percentage basis than the U.S., but that gives them a currency problem because there's not this like structural demand for their currency, whereas the U.S. Government can kind of get away with a longer runway there. And then the other side is that industrial base issue. And so, generally speaking, they try to maximize both, but it's often hard to do so. And if you look at parts of the administration, like they propose things like taxes on reinvesting capital in the U.S. So like if a foreign entity wants to hold treasuries, they might actually talk about discouraging that at above a certain scale by basically putting taxes on some of those assets and say, okay, you can hold treasuries, but we're going to take back some of those basis points and make that a little bit less attractive for you to do, to maybe discourage you from doing it. But then there are other parts of the administration that are saying, hey, we like stable coins because it'll get treasuries out into the world more and increase demand for treasuries. And those things have some degree of conflict with each other.
So what do you how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the deindustrialization. Yeah, I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where an administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem, and I think that there probably will be fits and starts along the way. And it'll take, decades to gradually unwind that and kind of reindustrialize.
All right. Welcome back to the Market Chronicles. We are on episode number 11, and you know what that means.
Another deep dive.
Another deep dive.
Into the markets.
Yeah, we're going to be taking a look at the insightful commentary from Lyn Alden today.
Yeah.
We've got some really interesting stuff to go over today. Really, her perspective on the current market conditions, particularly what's going on with Bitcoin.
Yeah.
And then also kind of like the bigger picture of what's going on with the economy.
Yep.
So
Absolutely.
We're going to break this down for you in a way that's going to make sense, give you that professional level understanding without overwhelming you with a bunch of
charts and data
and all that. Yeah.
Yeah.
Keep it lighthearted as always. If you're on YouTube, hit that subscribe button.
Yes.
So you don't miss any future episodes. Future deep dives.
That's right. Deep dive.
Deep dives. So yeah, Lyn Alden, she had some really interesting things to say about, market sentiment, particularly, when it comes to Bitcoin.
Yeah. I think what's really interesting is she's saying that we haven't really seen true market extremes yet in this cycle.
Yeah. And that's something that, people always talk about. It's like, when are we going to see the top? Right? Like, is it the top? Is that the top?
Yeah. And you look at
she's angry.
Like the March 2024 breakout to 73,000. It was, a little bit euphoric, but it wasn't that kind of like historical multi-year top.
Right. It wasn't one of those things where you're like, oh man, that was definitely a blow off top.
Right.
Yeah.
And then you look at even more recently, like the move up to 100,000, 108,000.
Yeah.
And again, there were some metrics that looked a little overdone, but it wasn't like this huge multi-year dislocation.
Yeah. And her analysis is basically like leading towards, a higher probability of breaking upwards rather than downwards at this point.
Yeah.
Yeah.
I think she's saying, until we see significantly higher prices, a multi-year bear market is unlikely.
Right. So that's something to think about.
It is.
Now, let's shift gears a little bit and talk about this whole executive order from the U.S. government, right? The one about seized and forfeited cryptocurrencies.
Right. With a particular emphasis on
especially Bitcoin, right?
Yeah.
And this is something that I think a lot of people were kind of like scratching their heads about,
Well, so
what does this really mean?
how does Lyn Alden interpret this?
Right.
Well, it seems like she's saying that this is essentially kind of ring fencing the Bitcoin that the government has. They're not going to sell it.
Right. Because they're basically just holding it.
Yeah,
You
and
know?
that's a really big deal because, people were worried that they were going to dump it on the market.
Right, and crash the price and all that.
Exactly.
And the other really interesting thing that she pointed out is that, it does kind of open the door, maybe not a huge door, but it opens the door for the government to actually find ways to accumulate more Bitcoin.
Yeah, it does. It says that the Treasury can explore budget-neutral ways to potentially acquire more Bitcoin.
Yeah.
So, I mean, it's not like they're going to go out and buy a ton of it.
Right.
But, there are these little ways that they could potentially
Chip away at it.
Yeah.
Right, and just slowly increase their holdings.
And that's interesting.
It is interesting. And the other thing that I thought was really interesting was how it really separates Bitcoin from the rest of the crypto world, right? It's like,
it's like Bitcoin's in its own category now.
its own thing. Yeah, it's like, the order specifically says, hey, don't sell this Bitcoin,
Right.
But then it says, oh, the Treasury Secretary, you can do whatever you want with all the other cryptos.
You can sell those if you want.
Like Dogecoin, whatever.
Exactly.
And Lyn Alden sees this as actually a good thing, right?
Yeah.
Because it's not like the government's picking favorites amongst all these different...
When you have all these other cryptocurrencies that kind of have these securities aspects to them or, have actual issuers,
Right.
It makes sense to separate Bitcoin because it's so different.
Yeah. And so her main takeaway there is basically we should expect that the government's not going to be selling their Bitcoin anymore.
Yeah. Which is
huge.
a big deal.
Yeah. Because that was always this like overhang, right? This fear of like, oh man, what if they just dump all this Bitcoin on the market?
Right. Yeah.
But she also cautions against, reading too much into it.
Right.
As far as like, is the government going to come in and buy $1 bazillion worth of Bitcoin and then the price is going to go to the moon?
Yeah. Don't expect like a huge U.S. government-driven bull run.
Right.
Her base case is still kind of like flat to mildly up.
Right.
Yeah.
It's more about removing that selling pressure than creating like massive buying pressure.
Yeah, exactly.
All right. So let's talk about what Lyn Alden's actually keeping an eye on these days. Right? Like what are the indicators that she's watching?
Yeah.
And it's interesting because it seems like she's kind of shifted away from like strict price targets.
Yeah.
And now she's really looking more at like market sentiment and these underlying conditions.
Yeah. She's really trying to get a feel for like when are we going to see that, euphoria, those levels of euphoria that historically have led to big corrections.
Yeah.
And so one of the things she's watching really closely is Bitcoin's correlation with liquidity.
Yeah. Now, when we say liquidity, I think a lot of people might just think inflation.
Right.
But she's talking about something a little bit
broader
than that.
Yeah, it's really tied to the expansion of the monetary base.
Right.
And she sees that as kind of like a key driver for how Bitcoin performs.
So basically like
Bitcoin does better when there's more liquidity sloshing around in the system.
more money printing.
Yeah, and she's connecting that to like a debasement narrative.
Right. So it's not just like, oh, prices are going up because of CPI. It's like, no, the actual value of the dollar is being diluted.
Exactly.
And then the on-chain metric that she's really watching here is the market value compared to the on-chain average cost basis.
Yes.
And this is something that, a lot of people might not be familiar with. So can you kind of break that down for us a little bit?
Yeah, so basically the on-chain average cost basis is like the average price that all the Bitcoin that's out there, all the circulating Bitcoin, was last moved on the blockchain.
Right. So like the last time it was traded.
Yeah. Okay. And so what she's looking at is how does the current market price compare to that average cost basis?
Right.
And historically, when you see like a huge divergence, like when the market value goes like 5 to 10x higher than the average cost basis, and it's driven by like a really small number of coins trading, that can be a sign of like unsustainable speculation.
Oh, that's interesting.
Yeah.
So like basically people are getting really, really excited.
They're getting euphoric.
But it's not based on like
fundamental.
A lot of actual buying and selling.
Right.
Yeah.
Yeah. It's just like a small group of people driving the price up.
And then everyone else is kind of like, oh, wow, look at that.
Yeah. And then as soon as that energy fades.
Right. Then it all comes crashing down.
The market's vulnerable to a correction.
Yeah. And she made this really great analogy with real estate.
Yeah. I loved that.
Yeah.
Yeah.
Can you kind of explain that for the folks at home?
So imagine you have a neighborhood where there haven't been many houses sold recently.
Okay.
And then one house sells for like way more than any other house is sold for.
Right, like a crazy price.
A crazy price.
Yeah.
Does that mean that suddenly every other house on the street is worth that much?
Right. Does that change the value of the whole neighborhood?
No, not necessarily.
Okay.
You need to see like a bunch of houses selling at that new level to really say, okay, this is the new average.
Yeah. So it's like one data point doesn't make a trend.
Exactly. Yeah.
And so she's applying that same logic to Bitcoin. Right.
Yeah. She's saying that those initial price spikes, they might just involve like a small fraction of the total supply.
Right.
The average cost basis only really starts to adjust upwards when you have more and more coins changing hands at those higher prices.
Right. So you need more widespread participation.
Yeah, you need that confirmation that this new price level is valid.
Interesting.
Yeah.
And her analysis is basically saying that we're not there yet.
Right.
Like we haven't seen that crazy divergence between the market value and the average cost basis.
No, not yet.
That would signal like, big correction coming.
Right.
Yeah.
It's not that euphoric widespread participation.
Not yet.
Where a small number of coins are driving the price way up.
Okay.
Yeah.
So that's something to keep an eye on for sure.
Absolutely.
All right. Last but not least, let's talk about Lyn Alden's perspective on, good old U.S. dollar, the world's reserve currency.
Yes, the big one.
The big kahuna.
Yeah.
And this is a big topic.
It is a big topic.
It's a complex topic.
With a lot of consequences.
Yeah, she talks about this monetary premium that the dollar gets.
Right.
Just by virtue of being the world's reserve currency, right?
Yeah, it's not just about trade balances and interest rate differentials.
Yeah.
It's like this extra oomph that the dollar has.
Yeah.
Because it's the world's money.
Because everyone uses it.
Yeah,
right?
Everyone needs dollars.
Yeah, and so even like
a company in France might finance a transaction with a company in Brazil using U.S. dollars.
Right, even though it has nothing to do with the U.S.
Yeah.
Yeah, it's just the currency that everyone uses.
It's the easiest,
Yeah.
most liquid.
Yeah.
Yeah.
And so this global demand for dollars, it can kind of leads to the dollar being overvalued.
Yeah, structurally overvalued.
Yeah, and this is something that has a lot of implications for the U.S. economy, right? Like
it does.
It affects trade, it affects...
Yeah, it makes our imports cheaper and our exports more expensive.
Right.
And that can hurt our manufacturing base because
people would rather buy the cheaper stuff from overseas.
Right.
Right.
Yeah.
And then all those dollars that we send overseas to buy that stuff, they often end up coming back as investments in U.S. assets.
Yeah.
Which is interesting.
It means we're basically trading ownership in our companies and our property for a bunch of depreciating goods.
It's like we're selling off the farm.
Yeah, kind of.
Right.
Yeah.
And she connects this to, bigger societal issues like deindustrialization and populism.
Right, because these economic shifts, they can lead to job losses.
Yeah.
And a concentration of wealth.
Yeah.
And that can fuel a lot of discontent.
Yeah, people get upset.
Yeah.
And it seems like the U.S. government is kind of in a tough spot here.
They are?
Because they're trying to balance, this desire to kind of like, realign trade.
Right.
But also maintain the dollar's status as the world's reserve currency.
Yeah, you can't really have both.
Right.
If you try to weaken the dollar to make your exports more competitive,
right,
that could undermine its role as a global reserve currency.
Right, and then everyone's like, well, why are we using the dollar anymore?
Exactly.
If it's not
–
strong.
Yeah.
And so there's all these like policy conflicts that she points out. Like, on the one hand, they might want to, discourage foreign investment in treasuries.
Right.
But then on the other hand, they might want to promote stable coins.
Right.
Which would increase demand for dollars.
Yeah. It's a tricky situation. It's like they're trying to have their cake and eat it too.
Yeah. And her long-term outlook on this is that it's going to be a very, very slow process.
Right.
Like decades long.
Decades, yeah.
Unwinding these imbalances.
Yeah, it's not going to happen overnight.
No.
Yeah.
These things take time.
All right, so let's recap here real quick.
Just to make sure everyone's following along at home. Lyn Alden's key insights. The Bitcoin market doesn't look like it's topping out yet.
Right.
The executive order on Bitcoin mainly signals the end of the government sales.
Yeah.
We need to see more extreme levels in those on-chain metrics before we should really start worrying about a big correction.
Right.
And the dollar's status as the reserve currency.
That's going to be a long and complicated story.
Yeah, it's going to be with us for a while.
Yeah.
And I think the key takeaway here for me is just how interconnected all this stuff is.
It is.
Right? Like we've got monetary policy.
Yeah.
We've got technology like Bitcoin.
Right.
We've got these global economic shifts.
And it's all intertwined.
It's all happening at the same time.
Yeah.
And it's all affecting each other.
Absolutely.
So it's really a fascinating time to be watching the markets.
It is.
And I think it's more important than ever to really understand what's going on.
You need to have that deep understanding.
So you can make informed decisions.
Yeah, and not just react to the headlines.
Exactly. Got to see the big picture.
All right, so that's it for this week's deep dive.
Yeah.
Thanks for joining us. We'll see you next time.
Next time.
On the Market Chronicles.
Take care.